Friends, do you often feel confused about where to put your hard-earned money? If you invest only in equity, the risk is very high. If you go only for debt, the growth is very low. But imagine if there is just one fund that can give you both growth and safety at the same time. This is exactly what balanced funds do. Hi, welcome to Renuka Kakinada vlogs. On this channel, we discuss investments, mutual funds, and wealth creation strategies, all in simple terms. Think of this channel as a roadmap to make your financial journey strong and secure. So, make sure you watch till the end of this video, because in this video you will get the clarity about balanced funds that you may have been missing all this time. What are balanced funds? Balanced funds are a category of mutual funds. As the name suggests, they are balanced because they include a mix of both equity, called as stocks or shares, and debt, called as bonds, government securities, and fixed income instruments. Think of it like a complete meal. Equity is like a spicy curry, exciting and full of flavor, but also a bit risky. Debt is like a plain rice, safe and stable, but not very thrilling. Balanced funds are like combining both, giving you a perfect, well-balanced meal. In short, one single investment gives you both growth and safety. Why balanced funds? A real-life example. Mr. Ramesh, a salaried employee, has savings of rupees 10 lakhs. If he puts it all in equity, the market could double his money if it rises, but it could also reduce it by half if the market crashes. If he put it all in FD or debt, his money will be safe, but the returns will stay at 7 to 8% only. So, what should he do? He needs something in between, growth plus safety. That is where balanced funds help. They divide his 10 lakhs rupees between equity for growth and debt for stability. How many types of balanced or hybrid funds are there? There is not just one type of balanced fund. Let us look at the three different categories of balanced funds. Aggressive hybrid funds. Aggressive hybrid funds invest around 65% in equity and balance 35% in debt. Higher risk but also higher chances of good returns in the long term. Example, SPI Equity Hybrid Fund. Conservative hybrid funds. Conservative hybrid funds invest around 60% in debt, 40% in equity. Lower risk, more stability, as this fund is investing more in debt than in equity. Example, HDFC Hybrid Debt Fund. Balanced Advantage Funds. These balanced advantage funds are very popular. The allocation between equity and debt changes automatically depending on the market conditions. Example, ICICI Prudential Balance Advantage Fund. The best part, you don't need to actively manage anything. The fund manager balances it for you. Let us now look how they work. Simple process. Let us say you invest rupees 1 lakh in an aggressive fund. Around 65,000 goes into equity and 35,000 into debt. In a conservative fund, around 60,000 rupees goes into debt and 40,000 into equity. In a balanced advantage fund, if the market is high, the equity portion is reduced. If the market is low, the equity portion is increased. This way, you get both protection and growth opportunities automatically. Now, let us discuss advantages. Why to choose balanced funds? Here are the main benefits. Number 1, diversification. Diversification in equity plus debt in a single fund reduces the risk. 2, tension free. No need to track the stock market daily. 3, perfect for beginners, as easy entry point for new investors. 4th benefit, long-term wealth creation. With patience, in 5 to 10 years, you will see good growth. 5th benefit, stability in market crashes. Even if equity falls, the debt portion protects your portfolio. The 6th benefit is tax benefits. Aggressive hybrids with 65% equity are taxed like equity funds, which is more favorable in the long run. Now let us discuss risks. Our honest view is no investment is 100% risk free. Even balanced funds have some risks. Equity portion can make the NAV drop in the short term. Debt portion can be affected by changes in interest rates. Returns are lower than pure equity but higher than pure debt. So it's a middle path, not extreme, just balanced. Then who should invest in balanced funds? The balanced funds are best suited for salaried people or first-time investors, those who can handle medium risk for retirement planning, goals like children's education or buying a house, people who don't know much about the stock market but still want their wealth to grow. Let me tell you popular balanced funds in India. HDFC Balanced Advantage Fund, ICICI Prudential Balanced Advantage Fund, SBI Equity Hybrid Fund, Mary Asset Hybrid Equity Fund. These are just examples. Always consult your financial advisor before investing. Friends, wealth creation is like a marathon. Pure equity is like a risky roller coaster. Pure debt is like a boring slow ride. Balanced funds are like comfortable, safe and growth oriented journey. For your long term dreams like retirement, children's future, children's higher education or long-term financial freedom or long-term wealth creation, a balanced approach can be a strong option. Remember, small steps taken today can create big victories tomorrow. If you found this video useful, then subscribe right now to Renuka Kakinada vlogs. Your support helps this channel grow bigger and stronger. Don't forget to like, share and press the bell icon so you never miss our financial wisdom. Until next time, invest wisely, live happily and wealthy. Thank you for your subscription.